To be completely honest, I kind of struggle today about how to introduce the subject I want to talk about, because it's often misunderstood and as a result people just brush it off and don't really pay attention. But if you invest in stocks, or if you have stocks in your retirement accounts, you need to care about this. You need to understand the potential impact of rising interest rates, which is what we're seeing now, on your equity holdings. When I was starting this channel 6 months ago or so, the idea was to post videos about finance, help people understand finance and investing better, help them become smarter about money and managing their money. And so today's video is one of those videos where I'm going to go over a concept that is very often misunderstood, but I think people don't pay attention to it enough and should, because it really influences how their investments perform, right? So if you invest in stocks, or if you have stocks sitting in your retirement accounts, this concept is important to understand for you. So one of the misconceptions that people have very often is that when they invest in stocks, that they invest in that particular company or the industry that the company is in, and that kind of acts in a vacuum. But the truth is, all markets, from equities, credit, fixed income, currencies, they all play off each other, right? And when something major is happening in one of those markets, that typically influences the other markets. Crises sometimes start in one market and then move to the next, right? Like 12 years ago in 2008, you had real estate really influencing everything else. And so the thing I want to talk about today is we have seen interest rates becoming higher and higher over the last 2 or 3 months, and that is likely going to impact investments in equities and how equities are valued. So if you look at this chart here, this is a chart from Bloomberg showing the yield of the 10-year US Treasury. Right, that's usually referred to, as the risk-free rate. This is the Treasury paper that U.S. government issues. 10-year is usually the benchmark that investors look at when they kind of think about interest rates and where interest rates are and how a lot of paper around it, including mortgages, etc., are priced off. Right, so this is the yield that people look at, and so you see it's right now it's at about 1.13. If you look back at January, February, we were just below 2% before COVID really impacted the US. The Fed slashed rates down to 0, and then the yield obviously went lower, down to 40% or so. And then for most of 2020, we didn't do much. But you see in November, December, and clearly in January, the yield is rising, right? And so how does this play in the discussion today? What does this have to do with equities? So just to briefly go over this concept of yield, right? Yield is simply the interest rate of that underlying treasury paper, right? Think about the treasury as a bond that a company issues. So in this case is the US government. They issue a treasury paper which has a maturity of 10 years, and the price goes up and down, right? So if there's a lot of demand for the kind of paper, if investors want to buy a lot of US treasuries, for example, because there's a flight to safety and because US government is seen as a risk-free kind of investment, then a lot of people will go and buy US treasuries. And that price is going to go higher, right? Because people are buying more. But that means the interest rate, the yield of the treasury goes lower. And so what's happening now is the inverse of that. Now you're seeing the yields go higher, which means the prices of these US treasuries, of these bonds, right? They go lower. And so why is that happening? So there's a few reasons why this is happening now and how that's influencing the stock market, or has the potential to influence the stock market. One is the economy is doing a little bit better. So the anticipation is that, as economy does better, the inflation will go higher and interest rates will go higher in time as well. So we're looking, 10 year from now, this is the 10-year yield. But the two biggest drivers here really are what's happening now kind of from December to January. So the Biden administration is coming in, and we had the elections in Georgia. The Senate was confirmed. So suddenly we have the Democrats in the House, 50-50 in the Senate, and you'll have a Democrat in the White House. And Biden already signaled a lot of fresh stimulus coming over the next months, right, to support the economy, recover from COVID, and kind of rebuild. So how is that financed, right? When you have a new stimulus, well, the US government has to finance it somehow. So they're going to issue a lot of treasuries. They're going to issue paper that investors will go and buy. And so suddenly if you have this huge flood of US treasuries into the market, then you don't have enough investments to kind of swallow that huge supply of treasuries. And that's going to drop, that's going to push the prices lower, right? Which means the yield, again, will go higher, which is the interest rate, right? Because the interest rate has to go higher to compensate people to buy the treasuries that not as many people suddenly want. So that's one thing. The second thing is that the US dollar has been going lower over the last year or so. The US dollar on the DXY basis, which is the kind of the weighted index for the US dollar against a bunch of other currencies, is down about 7-8% over 2020. And Donald Trump's administration had a policy of a weaker dollar. And so that's also pushing treasuries lower, because if you're a foreign investor and you know that Japan and China and a lot of foreign governments are heavy investors in US treasuries because that's where they park their money, well then suddenly if you're investing in a treasury that is going to be worth less because the dollar is losing value, you will also think twice about investing in these treasuries, right? So again, the treasuries prices drop because nobody wants them, and you have so much issuance coming to the market, and rates and yields of those treasuries will go higher. Now, how does that influence equities, right? What happens to equities when yields go higher? Well, when you think about equities and how equities are priced, the price of a stock today is really derived from a discounted future cash flows that the business is going to generate, right? That's how analysts on Wall Street value equities. They look at the future cash flows that they think the business will generate depending on how the business grows, and they discount them back to today's value. And that's how they derive some kind of a ratio that equities should be priced at. Well, suddenly if you have yields going higher and you're discounting by that higher number, by that higher interest rates, well, you get a lower number as a discounted sum of those cash flows. And so when you look at the PE ratios, the price to earnings ratios that equities are priced off, well, that ratio today for the S&P 500 is about 22, 23. But historically, it's been only 16. And so suddenly with yields going higher, and you look at where equities are priced on a PE basis, as an index, well, there's going to be pressure on the downside, because suddenly you have investors allocating money and thinking, where do I want to allocate money? Do I want to allocate money in fixed income, where I suddenly start earning more money because interest rates are rising, because bonds that companies and the US government are issuing, they are more valuable to me as an interest rate, as an interest that I'm earning, versus putting the money in equities where the discounted cash flows are suddenly lower and lower, and the valuations suddenly start making less sense. So this is how interest rates really play on equities. That this is a concept that sometimes is not very easy to understand because of the price versus yield and the inverted relationship between the price and yield. But when you have interest rates going higher, usually that impacts negatively on the equities. There is a sector, there are a few sectors that do well when interest rates go higher. One of them for sure is the banking industry, and you may have seen over the last month or two, December, January, the banks are doing well because, again, banks, JP Morgan, Bank of America, Wells Fargo, they make money when interest rates are higher, right? Because they lend to people and businesses at a higher interest rate suddenly because the rates are higher, and yet they only pay you a small amount of money when you deposit money at these banks. So when you have that spread a little bit bigger, then the banks make money and they do well in a rising interest rates environment. So that's one sector that I think will do well in 2021 as we have this reflationary movement and yields start pushing higher. All right. A little bit of a concept lesson today. This is a topic that's not very easily understood very often, and people don't really pay attention to it too much. But there is a level in interest rates that really starts impacting equities, and it's important that people understand this. I hope you enjoyed this conversation. I certainly love talking about these topics and understanding the wider concepts as opposed to invest in this or that company. Give a like to the video if you enjoyed it, subscribe to the channel, and I'll see you in the next video.